In today's episode, we are joined by Niklas from Heavy Moat Investments. If you've been following his work over on Substack or Twitter, you'll know he's all about finding companies with deep, durable moats, businesses that stand the test of time. But Niklas is not just about theory. He's been actively researching and investing in unique European companies from the likes of Frosta or and Sartorius Stadium to more niche names like Pluxee and Edenred. We dive into his investment philosophy, his process for identifying real quality, and the sectors he's excited about, but also the sectors he wants to avoid. We will also talk about how to value these companies and when it's time to pull the trigger. It was a fascinating conversation. Enjoy today's chat with Niklas from Heavy Moat Investments.
The worst day on Wall Street since the crash of 1987.
The Dow traders are standing there watching in amazement, and I don't blame them.
Could anyone do the same thing you did starting today?
Are you born with it? Is it DNA? Is it some early childhood exposure?
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are.
To give up what you're doing well because of guesses about what's going to happen just doesn't make any sense to us. I mean, we are going to be buyers of things over time.
What I needed to get ahead was to compete against idiots. And luckily, there's a large supply.
Welcome, Niklas, to the Dutch Investors Podcast. Once again, it's not unfamiliar territory for you anymore. You've been on the podcast a couple of times now, analyzing French flavor and fragrance company Robertet with me, and recently Pluxee with Luc. So welcome back. Glad you took out the time to do this with us, especially on a beautiful sunny day as today.
Yeah, nice to be back here. I did not expect to be back as soon, but here we are, ready to talk about investing.
Yeah, maybe you'll become a regular. We'll see how that turns out. Before we talk about moats, investing, your investing strategy, most people probably know you by your Substack name, Heavy Moat Investments, or Stonk Metal from X, or previously Twitter. Perhaps we can start there. So can you perhaps briefly introduce yourself to the audience? Who is Niklas? Where you're from? And maybe share how Heavy Moat Investments came to be.
Yeah, sure. I'm Niklas. I'm from southern Germany, and I'm 26 years old. I started investing in 2020, at least in stocks. I did some other stuff before, but nothing too serious and not much to talk about. But I got into investing in stocks in 2020 with the whole market uncertainty and the Corona crash. And basically it was from a university lecture where I studied business informatics. A friend of mine had a finance course, and for me it was scheduled for the next semester, but we still talked about it. And they had a demo portfolio where they had to make a portfolio over the whole semester as a task. And we started talking about stocks, and I noticed how interesting it all is and how diverse it is. You can basically learn for a decade and still only scratch the surface. So ever since then, I got a little addicted to the whole market understanding companies and investing my own money. I started pretty much from the beginning to document it all on Twitter. And if you go all the way back, you still have some pretty amateurish takes from me. But I think over the years, I learned a lot. I went through a lot of different investing styles, especially in the beginning, trying to figure out what I wanted to do. And eventually got to my current philosophy and also strategy. In 2022, I got a message by Seeking Alpha if I wanted to write there. So that's what I had been doing for, I think, 1.5 years. No, 2 years actually. And in 2024, I went over to Substack and started to publish myself.
Yeah, I love what you said, where you said you can do this for decades and still keep learning and learn a lot. It's like a never-ending journey of professional and personal growth, which we love as well. So what's interesting is that a lot of people spend years working on their skill set, working on ideas, reading, perhaps building frameworks, and they never really share any of it, which is fine. But you made the choice to put yourself out there in the world. And I think that's worth exploring a bit, because whether you're managing money or just thinking through ideas, writing publicly forces a level of responsibility, clarity. You can get a lot of pushback, you get a lot of skeptics, which most people try to avoid. So what made you want to start sharing your research under this name? And was there a moment where you just thought, well, you know what, I'll just go public with all of this?
Yeah, so from the beginning, I wanted to journal what I'm doing. And if you just journal yourself in in a Word document or even written by hand, you still can make up your mind and try to trick yourself. Yeah, the decision wasn't wrong. It just was unfortunate or whatever. And I think like if you do it publicly, you have a different level of transparency, and also you have people who can take you accountable. It doesn't mean that you have to owe them anything, but it just makes the experience a lot more real. Let's say you do think about what you try to write more if you do it publicly. And also, as you said, you get pushback sometimes, and we can research as long as we want. If we have some bias in our head and nobody challenges it, then we oftentimes can run into mistakes, and doing it all publicly and getting pushback can help there. And also having conversations makes you keep growing. You figure out stuff you wouldn't have found otherwise, and yeah, it just makes the experience better for everybody. In the end of the day, investing is a personal story, but we don't need to go the way alone.
And then there is, of course, your name, Heavy Moat Investments. It's a good name. It's simple. It sticks, but it also says something about the way you think and and what you look for. There are a lot of people who say they invest in moody businesses, in quotation marks. It's become kind of a buzzword maybe since Buffett threw it out there years ago. But putting that word heavy right in the name suggests you're looking for something more than just a strong brand with good economics. So where did the name come from, and what does it mean to you?
The name has two aspects. The first one is the Moat Investments. I think starting in 2022, when I found roughly to my current philosophy, I started to look more into companies with high competitive advantages. Basically got there after reading 100 Baggers, which goes a lot into the concept of long reinvestment runways and high quality businesses, and just keeping shares for the long term. Previously, I was mostly into growth investing with all the pandemic darlings, thinking that you can only get high returns if you have high revenue growth. I mean, there's some truth behind it, but a lot of the hypergrowth companies slow down, and often they are way too expensive. And what I try to look for is consistent, moderate growth for like 10 to 15% over the long term, and with a consistent and strongly competitively advantaged business. And then the other part is the heavy, which is a reference to my love for heavy metal music and all kinds of extreme music. So I tried to combine those two, and it ended up sounding pretty good. That's also how I made my logo with the metal fist and a chart going up. So yeah, it's a combination between my investment philosophy and also my personal hobby of listening to music.
If you didn't tell us that, I would have thought that it really was about finding like heavy moats in a company, white moats. So
I mean, that's also part of it. I mean, some people also thought it meant looking into companies with a heavy moat and in terms of capital intensive, which is something I tried for a bit in some investments, but it's not really my style. But yeah, I really like the name. I'm very glad I changed to it a few years ago, and yeah.
You mentioned having tried many different investing styles. I think you said that a few minutes ago. What did you mean by that? What did you discover during that period?
Yeah, so starting off, I was a lot into like companies I knew, stuff like Coca-Cola, Colgate, Palmolive, and all the let's say boring dividend companies. Then I got influenced by the whole market hysteria in 2021 and bought fast-growing tech stocks like Square or Teladoc, Fiverr, and all the kind of unprofitable stocks that went up 500% and then crashed 90%. Ended up losing some money and learned a lot from it. And then after reading 100 Baggers, as I said, I went more into quality investing, I would say. And as time went on, I also put a heavier focus on value investing, because a lot of the typical quality investing crowd is concentrated on a lot of high quality companies, but without a lot of regard to valuation. And I mean, even the best company is not a great deal if it is trading at 50 times earnings and growing at 7% a year. Looking at stocks like Cintas, very good business. I would love to own it at the right price, but that price is like 60% lower probably. I haven't done the evaluation in a while, but a lot of people, I feel like, just
Yeah, it sounds it's a way for many investors to simplify investing to almost a single sentence, in a way where you say, I will buy high quality companies no matter the valuation and hold them forever. And I agree that it doesn't work like that.
Yeah, I feel like people just take Buffett quotes and put them way too literally and put their own spin on it. And especially in this instance, I feel like a lot of people quote Buffett saying he would rather buy a great business at a fair price than a fair business at a great price. But if Buffett says that, he means like paying 20 PE instead of 15 PE and not paying 50 PE. So yeah, I feel like Buffett is probably the person that gets misquoted the most in investing, and yeah, I'm not a big fan of that.
What is it about investing you like so much?
I like the aspect that it's so different wherever you look. I have a portfolio of 20 businesses, and most of them are very different. They share some similarities, but they all have their unique points. And it's just a never-ending story of things you can discover, things you can learn about. And you also learn things about the real world, like knowing how businesses work. We interact with businesses all the time. You start to understand the world better, and it's just a very mentally stimulating part-time activity, I feel like.
Let's shift gears a little bit and talk about how you actually approach investing. Not in the technical sense, we'll get to that, but more in terms of how you see the world as an investor. Because everyone's got their own lens, right? Some people are laser focused on, I don't know, the moat or valuation. Others care more about the management team, people. Some want momentum. I can imagine you being from Germany also changes your view a little bit on investing compared to, say, an American investor or an Asian investor. So let's start at the top. How would you describe your investment philosophy? What do you look for?
So if I would have to put an umbrella term over it, I would say quality value investing. And I try to focus on businesses with a large and growing competitive advantage, led by talented people, and that can allocate capital well, preferably by reinvesting back into the business and then returning all excess capital to shareholders. That's like the ideal business, and I try to own them for the long term. But what I noticed is that it often doesn't work out to own businesses for, let's say, buy them and own them for 10 years. I have a lot of turnover, maybe too much, but I think that's fine. I see it as buying a company, seeing if I like it, or I like owning it, and then putting more money into it. I also try to own businesses that add value to society and not just harm people or just are not a net positive. I mean, like, for example, gambling companies, in my opinion, do not add anything to the world. They just take away. And at the end of the day, I want to be an owner of these businesses. I want to be along there for the long term and partner up with a management team. So I must stand behind the business ethically. So that's also a part that I try to look at.
Yeah, one thing that's always interesting is how people develop a kind of gravitational pull towards certain types of companies. You said you like or look for quality companies, perhaps companies that add value to society or you stand behind ethically. How do you define quality? It's a word that gets thrown around a lot. Some people say it's consistent cash flow, increasing returns on capital, pricing power, whatever it may be. So how do you define quality?
I asked myself the same question a while ago, and I ended up developing a 30-category quality score where I look into management incentives, secular trends, financial strength, moat, growth, and earnings quality of the business. So I look at some of the things that most people look at, like return on invested capital. But especially return on invested capital, I feel like is used too much and not in the right way. Just having a high return on invested capital does not really help a lot. You need reinvestment. And I feel like a lot of people can get sucked into just looking at ROIC. So for me, especially the capital efficiency part is consistent of 3 parts. ROIC needs to be high. We need to be efficient with what money we invest. Then we need to have a high reinvestment rate so that we actually benefit from a highly efficient investment. And then we also have to have a good capital return policy, because ideally we want businesses that can reinvest all of their cash flow and even more, take on debt and expand the business. But in reality, the highly successful businesses are generating too much cash to reinvest it all. And then we ideally want all excess cash returned to owners so that we can decide what to do with it, be that through share buybacks at opportunistic prices or just as dividends.
It's funny you say that. We actually made a podcast a few weeks ago. I think it was called 5 Universal Laws of the World Applied to Investing. And I'm not sure I'll have to look it up, what the law exactly was, but it was about once people start using a metric, 50 years ago, or let's say 30 years ago, it was the price to book ratio. Everybody just looked at the book value of a company. And it was a great way to find a lot of great companies. Cigar butt investing, Buffett used to call it, I believe. But once people start using a metric and it becomes so mainstream, so ROIC is one of these metrics that everybody just looks at right now, it actually kind of doesn't start working anymore. Because if everyone can see that a company has a return on invested capital of, say, 25%, everybody knows it's a great company, but the valuation will reflect that as well. So the returns won't be as good as before. So I agree with you on that. You have some really unique companies in your portfolio. You share them publicly on your Substack. Many of them, I believe, are European. To give our listeners some examples, I believe Frosta, EVS, Sartorius Stadium, Pluxee, Edenred, Ecker and Ziegler. I mean, these are not the Nvidias and Microsofts of this world. So why are you drawn to those types of companies?
Yeah, as I developed as an investor, I tried to look at smaller companies. I feel like it's just a much more interesting experience. You don't have the whole noise that you have if you look at Nvidia. Everybody has an opinion on Nvidia. You have hundreds of articles on it, and I would rather look at some hidden champions that are not on everybody's radar, but that are consistently growing the business, oftentimes trading at cheaper valuations, and oftentimes are being owner-led. Yeah, that's also why I shifted my geographical exposure over the last, let's say, 2 years, I think. I don't really care where my companies come from as long as it's a democracy. But I noticed that American companies are just trading at way too much of a premium. And that's why I put most of my new money into European stocks and also some Latin American stocks. And right now, without really forcing it, I have diversified to a point where America is just 20% of my portfolio, 30% if we include Canada. And the majority actually is Europe right now. We have a lot of great owner-operated companies, a lot of the ones you just mentioned. And yeah, I'm very happy with this approach. And so far it has worked out well, especially this year. And we'll see how it continues in the future. A lot of uncertainty, especially in the American market. And I mean, even after the small correction, US stocks still trade at a very large premium. And we need to see if the premium is justified. It certainly is for some companies. They have some amazing businesses over there. But I would not be comfortable at this point to just outright own an American index, for example.
Yeah, there's a lot going on, and I'm no fortune teller, but I would say that in the long run, say 10, 20 years from now, this uncertainty and America pushing us away, and by us I mean Europe, is going to be net positive for Europe. They are investing a lot more into the European landscape right now. I think this will benefit European companies in the long run. We'll have better connections with countries and that are closer to us. I think we'll have a better relationship with China in the long run, with Canada, we are sticking to our values, and I think in the long run this will pay off. And your European portfolio is poised to benefit from that, I believe. Are there any specific traits or red flags that make you skip over a company, even when it looks very cheap on a valuation basis?
Yeah, so I try to avoid companies with unpredictable earnings and high churn. Something I look at is recurring revenue and also visibility of revenue. And over time, I noticed that most of the times I got burned, it is in an industry, like a cyclical business where I did not understand the cycle correctly, where earnings is falling off a cliff, for example, or where projections from management are just way off. And having predictable businesses counteracts that. Then I also try to avoid immoral businesses, as I mentioned earlier, because I want to be an owner and I want to stay behind the company. And then I also don't like empire building. I do invest in roll-ups, but I prefer if they do small bolt-on deals where they integrate a business or let them run it decentralized. I don't like companies doing large mergers. That's also one of the reasons, for example, why I sold my shares in Alimentation Couche-Tard, the largest operator of gas stations and convenience stores, who tried to make a merger with 7-Eleven. At the time of the proposal, I think Couche-Tard was worth 70 billion and 7-Eleven was 60 billion or something like that. So just way too much of an integration risk and just way too high of a leverage needed for that. So I would call it empire building, and I'm not a fan of that.
I would like to dig into something that sits at the heart of your approach, figuring out what actually makes a business great. Because it's one thing to say, this is a good company, this is a great company, this is a bad company. But it's another to explain why, what gives it staying power, what allows it to keep growing, defending its turf, and reinvesting at high returns year after year, the reinvesting runway you mentioned previously. And for a lot of long-term investors like yourself and us, the answer tends to come back to the idea of a moat, right? The buzzword moat, something that protects the business. So in your experience, what are signs of a truly durable competitive advantage other than what everybody can see, say a high return on invested capital, for example?
I think one part is what kind of moat it is. Oftentimes duopolies or oligopolies with a few players are pretty interesting, because you have great scale effects, you have network effects, and oftentimes it's very hard for new entrants to convince customers to come to them. For example, Pluxee and Edenred, it's not a real duopoly, but I think they have like 65 or 70% of the market in employee benefits. Pretty hard to convince a new entrant into the market to convince customers why they would use their network instead of the already established ones with more services and just a larger network. That's one part. I also like focused pure plays. I don't like companies who are too diversified into different markets. Oftentimes we have a monopoly, or not a monopoly, but like a leader in an oligopolistic industry with distracted competitors. A great example for that is IDEX Laboratories, who does diagnostics for pets and other animals. They have the market leadership, and their only competitors are a subsidiary of Mars and a subsidiary of Zoetis. So they are really the only company with a focus on it, and it shows in their great performance over the last decades. Oftentimes I also think a long reinvestment runway is a sign of a durable advantage, because it means that a company figured out how to scale their business. It's not just luck, they have a process. And if scaling is done correctly, it also means that margins and ROIC will elevate over time. So those are some signs I look at.
Yeah, and perhaps even ROIC, return on invested incremental capital, right? Which
yeah, exactly. So I mostly just look at ROIC and reinvestment runway, or like reinvestment rate. You can combine those to ROIC, and yeah.
You mentioned duopolies as a sign of a strong moat. In the case of a duopoly, say Visa and MasterCard, Edenred and Pluxee, or even Boeing and Airbus, do you analyze both companies, or do you buy both companies to avoid betting on the wrong one?
I mean, that depends. I started out, for example, buying Pluxee and later buying Edenred. In that case, I should have started to look more seriously into Edenred earlier. I noticed that both companies are great, but there are also instances where there is a duopoly without two great businesses. I would say Boeing and Airbus is one example. Boeing has a very troublesome history. It's, in my opinion, a horrible company that's cutting corners to push margins, and in the end killed a lot of people that way. I have not analyzed the business, and neither did I do for Airbus, but that would be one instance where I certainly wouldn't own both. Another example is Copart, which I own. They have a competitor in the duopoly, which is IAA, which got acquired a year ago or 2 ago. And Cobalt is consistently taking market share and having just a way better focus. They are still owner-operated, and they just have a much better culture and long-term focus. So that's also one instance where duopoly has a much better player, which, to be fair, also trades at higher valuation. So I think oftentimes these duopolies have very good economics, and oftentimes they are both run well, but it's not the case every time.
And for those that want to know how horrible of a company Boeing is, there is a great documentary on the topic you just mentioned, Downfall, the case against Boeing. And it's about what you said. They're cutting corners. Yeah, they missed on safety procedures. It's a very good documentary. I highly recommend it. And it was actually, there was an analyst years before the documentary that said, how is it possible that Boeing has doubled the margins of Airbus? They basically do the same thing. And years later, it came out that they were cutting corners on safety procedures, and that's how they increased profits. Crazy to think about.
Yeah, and especially if you are a business that's has such a big responsibility for keeping people safe.
Yeah.
And instead they dumped hundreds, or almost $100 billion into buybacks at high prices. So also a good case study on capital allocation.
Absolutely. To expand a bit on moats, Elon Musk, the beloved Elon Musk, once said, if your only defense against invading armies is a moat, you will not last long. What matters is the pace of innovation. That's the fundamental determinant of competitiveness. And whether you like Elon Musk or not, I'm not here to debate that. I think there's truth in what he said there. Some moats get lazy, others evolve. So I'm curious where you land on this. Do you believe most moats erode over time, or can they be maintained and strengthened?
Yeah, I think over the long term, culture is almost as important as the moat. It's very hard to assess though. There are some companies where they are said to have a strong culture, but at the end of the day, you can only really know that if you are an insider into the company. We can just see from the outside. We can look at things like Glassdoor to get an opinion, but it's very hard to assess. But I think if you have a great culture, it is a lot more likely that your company and your moat will continue to evolve and grow. A great example for this is Watsco, which is the leading distributor of HVAC equipment in the United States. They have a strong Okay, let's do that again. They have a strong ownership structure, and I think 60% of their employees own shares and have a good incentive. They acquire businesses and then let them decentralized operate, and it's working pretty well, and it will probably continue to go pretty well. So we should look at culture as well. And if you have a strong culture, you will jump onto technological trends, and you will continue to develop your business and defend the moat. An interesting example here also is EVS Broadcast, which I think you also own. They had a breakthrough in I think it was early 2000s with their playback technology for sport events, and then they just decided to jump prices up. They ended up with, I think, 60 or 70% EBIT margins. They just were milking customers and not really reinvesting. They were just trying to milk it forever. And what's a price that does not work? Competitors came in, made similar products, even though they were inferior to EVS, they were still a lot cheaper, and that made it attractive. And they ended up having I think, whole decade with declining results. Then they got new management, which focused on the culture, focused on getting the company back to speed, and now it's a great success story again. And also one of my largest positions. So yeah, culture is essential if we want to know if a moat will last over time.
Yeah, I absolutely agree with you on that. I think management and culture, soft fundamentals, I like to call it, are more important in the long run. It might be a bit controversial or even an unpopular opinion, but that's just my view and your view, I guess. It's something we as investors cannot really assess, which makes it so hard to grasp, right? And investors don't like that. They want certainty. They want hard facts, signs of a strong moat. So having fast revenue growth, increasing market share, high margins, good returns on capital are just things they prefer looking at. And it makes sense. I mean, we're all human. And to close this section out, let's talk about some misunderstood moats, the ones investors love to talk about, but maybe don't always interpret correctly, or maybe the ones that are actually very strong, but don't look that way at first glance. Is there a type of moat you think is overrated, or maybe one that's even underappreciated, but quite powerful?
I'll look at this question from another angle. What I find very important and which increases in importance for me is recurring revenue and predictable revenue, especially if you can have a low churn rate over time. It's an immense advantage if you can grow your business within your existing customer base and you don't have to use your selling and marketing dollars to recruit new customers. You can instead focus on upselling your existing customers, and it's just a great concept that most of the time ends up in very scalable businesses with high margins. And I feel like a lot of companies rely on single sales of large machines, for example, or on project basis. And yeah, ideally you want a loyal customer base, which is growing moderately, but is strongly upselling from the existing base.
So I would love to talk a bit about your process. Can you walk us through your research process from the moment you catch an idea? I think you mentioned on our previous podcast that you find ideas everywhere. You like to copy ideas from others like Monish Pabrai and take a look at it yourself. So what does your research process look like? You find an idea and then what?
Yeah, exactly. I like the concept of cloning. We don't get any bonus points for creativity and investing. I like to just read also on social media and just in conversations with other investors. And you stumble across a lot of new businesses all the time. And when I find something that sounds remotely interesting, I take a look at it. I do a quick check. Oftentimes the investor presentation is a good point for that. You see how the business is portraying itself, and if I like what they say, if it ticks my boxes, I go deeper. I run it through my quality score and I do a valuation. And if it's still interesting, then I'll dive deeper and look into the annual reports and additional resources. And if it is still a good business then, and if it's more attractive than what I already own, and if I have cash, of course, then I start a position or keep it on a watch list.
So is the quality checklist like the final decision, or is it more of a pre-selection checklist where it passes most of your quality checklist and then you start doing more research?
It's mostly just a somewhat structured way to think about a business and to see if it ticks my boxes, if it has a strong balance sheet, if it has strong margin development, if there is a secular trend behind it. if management sounds credible and is incentivized right, if there is a good growth opportunity, and if it's effectively run. So I don't buy my companies based on the quality score. It's just a mental crutch, I would say, to make companies somewhat comparable and to quickly assess what are their strengths and what are their weaknesses.
I see. So how do you build conviction in these smaller companies you own? I mean, if you own Microsoft, for example, and it drops 20% the next day, I wouldn't be too worried. I think Microsoft will still be here 10, 20 years from now. It's one thing to build conviction in a large blue chip company, in a well-known compounder, but it's another to feel confident in a smaller, lesser known company, perhaps small caps or even micro caps. Many of your companies are not large companies if you look at it on a market cap scale. So how do you build that conviction in these smaller names?
What I like is owning companies with long histories. And even if we take Pluxee as an example, they went public as a spin-off a year ago, but they still have a, I think, 40-year history underlying the business. So if we know that the business has been around for a long time and has management that owns shares in large quantities, then that's already a good point. We want to know how management thinks, at least roughly, to know if they are in for the long term or not. And at the end of the day, we can only do so much as investors. I need to feel comfortable with the management. And sometimes you own a business and you notice that you are not confident with the management, and that's then often a good sign to sell the position or think about trimming. What's definitely a point with smaller companies is volatility, and especially liquidity. I think there was a week last year where there was no single Froster share traded for a whole week. So if you buy these smaller companies, a rather small buy or sell can drive prices. So you need to understand the overlying growth trends. And if news come out, you need to think about if it actually matters over the long term. And I think especially for nano caps, I recently bought a business which is by far my smallest market cap, with I think like 30 million. And I noticed that it is a lot more volatile than the other things I own. Not sure yet if I like it. It's a small test position with, I think, just 1 or 2% of my portfolio. So yeah, it's a process. We buy a business and then we see if we are comfortable with it over time. And yeah, eventually the good ones, the ones you like, will stick around and the others will be sold.
I would love to shift gears to valuation, because when you find a great business, which we mentioned, you have a strong moat, you find great management, it has predictable growth, it has a long reinvestment runway, but at the end of the day, the price you pay still matters. And that's where things get tricky. I think that's where most investors make their mistakes, besides their selling too soon or buying too early. Everyone has their own approach. Some run full models, some rely more on mental math, others lean on comparisons or past experience. So how do you go about valuing a business? Do you look at multiples or do you lean more towards intuition?
Yeah, so this process, of course, also developed over time. In the beginning, I was just using very basic metrics like PE ratios. And at some point during the height of the pandemic madness, I even valued some companies on price to sales and price to gross profit metrics. Then I started to look into inverse DCF or reverse DCF, however you want to call it, where you basically try to find out what assumptions the market is making for the business to grow at to achieve a, let's say, 10% return. The problem with inverse DCF and DCFs in general is that you punish high quality businesses with the perpetual growth rate. So after most DCFs are on a 10-year basis, and you have your growth rate for the next 5 years, for the following 5 years, and after year 10, growth drops to GDP. So most of the time to 2 or 3% growth. I would argue that a high quality business will not decelerate from 10% to 3%. And that makes DCS pretty tricky, and oftentimes makes high quality businesses look overvalued. So what I started to do is using an IRR model, which uses an exit multiple instead. Here I try to look at the basic drivers of returns, which is most importantly revenue growth, then also margin development, capital returns through buybacks, or in the negative case, dilution, which is then a headwind to returns, and also dividends. And then lastly, we have an exit multiple. Of course, this approach has more assumptions we have to make, but I feel like if we stick to conservative estimates, we don't project horrendously high growth rates, and we have realistic exit multiples. A lot of the times I try to model with decreasing multiples. Like I don't feel comfortable putting much more than 20 times as an exit multiple, even if the company is growing fast. So I feel like that way we can get a good general grasp if we use this approach and have a bull, bear, and base case. So that's what I've been doing over the last year. But really, you can also simplify this process. An idea should be a no-brainer if you want to buy it. I don't really care if I get a 10.7% or a 10.65% IRR. I care if it's 15% or 20%. And at that point, we have a good margin of safety. And there are some businesses right now that have declined a lot or gone sideways for a long time, like IDEX Laboratories or MSCI, but I still do not find them cheap enough. So eventually they will become a no-brainer and I will buy them, or they will not. And that's how I look at valuing high quality businesses.
So what does your sell discipline look like? Is it purely valuation driven? Is it a combination of a thesis driven and valuation? Is it more instinctive?
Yeah, it depends. I have sold for all cases you mentioned. There were situations where I just noticed that I'm not that comfortable owning the company. That could be, for example, that I when I owned Ashtead Group, which rents out equipment for construction and other sectors. The economics are good, but I'm not that comfortable with the very high capital intensity of the business. So I ended up selling. Then there were also cases where the investment just doesn't work out, where growth is way behind what I expected, where management is just way off on their estimates. And then there is also just valuation. I try to update my valuation once a month for my portfolio update, or also more frequently if there is a big price decline, for example. If a company falls to an IRR of like 5%, 6%, then I start to consider trimming. Because usually I have enough options with higher IRRs of 15% plus. So I try to not trim too much, but if a company just gets way too overextended, and if I don't see a credible way to make good returns over the long term or the medium term, then I'm thinking about trimming, because it happened enough times in the past where stocks are overextended and then correct again, and you get a better entry point again. But we need to make sure that they are not just some overvalued, but that they are really overvalued, because we always have to keep in mind that selling a stock causes some tax implications, and taxes can eat up a lot of returns if we trade in and out too much.
Yeah, it depends where you live, right? It's probably different everywhere, but overall, it is something to look at. Before we wrap up, I always like to end with a bit of a forward-looking curiosity. You've already given us a ton to think about, but I'm sure your research pipeline is still full. So for anyone listening who wants to dig a little bit deeper or maybe get a head start, are there any companies or industries you're currently looking at, something that caught your eye lately or might be interesting to keep an eye on?
Yeah, so one company I recently analyzed more deeply and also wrote about it on Substack is IDEX Laboratories. As I already mentioned, they do diagnostics for animals, especially pets. And it's just a fantastic business. It has one of the highest rankings I've had in my quality score. And I'm hoping that they drop more in price so I can own it. Then I also looked at MSCI, which most people probably know, which also has scored very highly and that I would love to own at the right price. Then I also recently looked at a more unknown company, a recent IPO from France, Planisware, which does project management software, which is a very sticky SaaS business. I still would like it a bit cheaper, especially because I have not had the best time with the last when I bought an IPO the last time with Pluxee. The problem with IPOs is that you don't have a public record of the business. You know that they have a long history of running the business, but you don't know management well. There is not much out there, so I'm trying to be a little bit more cautious this time with this company.
Yeah, I tend to have a rule for myself, but it depends on, it's different for everyone. I avoid IPOs for the first 24 months. But yeah, overall IPOs can be interesting, but they're usually pretty expensive when they come to the public markets. That's the reason they come to the markets anyway, so.
Yeah, that's also why spin-offs can be very interesting, because they oftentimes don't go to the market because they are expensive and want a high valuation, but because a business wants to streamline its operations and separate oftentimes also a faster growing business that might do better as a standalone company.
Yeah. Zooming out for a second, Heavy Moat Investments has grown into something a lot of investors really value. I think you're close to 10,000 subscribers now. We follow you closely. We like it a lot. And it's clear you're not just throwing out ideas, you're building something with care. So I'm curious to think about your next chapter. What is the goal with Heavy Moat Investments? Where will you take it over the next few years?
Yeah, for now, I'm not changing much. I want to continue journaling my process. I want to deliver value to my subscribers, and we'll see where it goes. I've got a good foundation, but it's not something that I could live off yet. But maybe over the next year or two, I can grow it into something bigger, where I could actually decide to make it my full-time profession. But ideally, I would work towards making it a big enough source that I can contribute most of my time to it. But yeah, time will tell. I'll continue to stay true to my ways and not try to engagement farm like most people sadly are doing. It's also going over to Substack. I feel like not a trend I like, but that's the nature of the business, and yeah, we'll see where it takes me.
So where can people follow you and learn more?
Yeah, the best place is my Substack, Heavy Moat Investments. Besides that, I'm also on Twitter, but I'm not that active at the moment because I don't like the direction it's going. And especially in these times, half of the posts on my timeline are about tariffs and other things and politics and just stuff I don't want to read about all the time. So the best way is Substack. You can also message me there. My messages are open and always happy to answer questions, and you can also participate in my chat.
To end on a positive note, what advice would you give to someone starting out today, trying to get better, trying to build insights as an investor? What advice would you give to someone?
I would tell people to start journaling. Think about your ideas and write them down. That way you can be honest to yourself and grow as an investor. There are so many communities and publications out there that you can have good conversations. You can challenge your ideas. You can figure out new ideas. So I would definitely try to put yourself out there. Doesn't have to be public. You can just message people and
and to add to that, don't be afraid to ask questions, make mistakes, and journal is a very good way of keeping yourself responsible. So a great tip to end this conversation. It's a wrap, Niklas. Thank you so much for coming on the show once again. We really do appreciate it.
Yeah, thank you for having me.
Enjoy your day out in the sun, and we'll talk to you again soon. Bye, everybody.
Bye.